Super Microcomputer Inc. is currently trading at $30.06 USD, seeing a minor intraday dip of 0.21% today, January 30th, 2026, as of 11:05 a.m. GMT-5. While this fraction of a percentage point move might look like the stock is just idling, the reality is that the company is standing on a knife's edge between a massive operational comeback and a lingering regulatory shadow. Most investors looking at their Robinhood investments or checking the Fidelity mobile app see a stock that has lost a significant portion of its value from the triple-digit heights of 2024 and assume the story is over. The expectation is that SMCI is a broken growth story, hamstrung by the accounting scandals and internal control weaknesses that plagued it last year. However, the reality is that just 3 days ago, on January 27th, the company officially regained Nasdaq compliance, and its Taiwan subsidiary just secured a $710 million credit facility to fuel a massive $36 billion revenue target for the fiscal year. If you are watching Nvidia stock or Apple stock for signs of AI demand, you are looking at the architects, but with Super Micro, you are looking at the builders who are currently sitting on over $13 billion in Blackwell Ultra orders. The tension in the current price action is a direct result of the expectation versus reality trap. The market narrative suggests that Dell and HPE are eating Super Micro's lunch by leveraging their superior sales teams and aggressive pricing, but the reality is that Super Micro still commands a 70 to 80% market share in liquid cooling solutions, which are becoming the absolute standard for high-density AI data centers. While the margins have compressed to about 9.5%, a significant drop from the 14 to 17% we saw in the past, the company is intentionally sacrificing short-term profitability to lock in these massive Blackwell deployments. This is a classic land grab strategy. If you are using SoFi Invest or Interactive Brokers to trade this, you're seeing a company that is trading at a forward PE ratio of roughly 13x, which is absurdly low for a firm projected to grow revenue by 60% this year. The curiosity loop for the smart money is simple. Can a company with this much physical infrastructure and a $2 billion credit line from JP Morgan really stay at a $30 valuation once the DOJ investigation is finally put to bed? When you manage an individual brokerage account or look for investment help on various investing sites, you are often warned about material weaknesses in financial reporting. The expectation is that where there is smoke, there is fire, and the accounting issues of 2024 will haunt this stock forever. But the reality is that with BDO now acting as the new auditor and a fresh compliance plan in place, the company has cleared its biggest hurdle to staying listed. Just this week, they amended their credit agreements to align their fiscal representation with a June 30 year-end, signaling a high level of coordination with their lenders. This isn't the behavior of a company that is hiding from its creditors. It is the behavior of a company that is cleaning its house so it can scale to meet the demand for Nvidia's Rubin architecture, which is already looming on the horizon for late 2026. Comment below how many shares of Super Microcomputer you currently hold, or if you think the accounting scandals of the past have permanently damaged the brand's reputation with institutional buyers. The business model of Super Micro is built on what they call data center building block solutions. Unlike their competitors who sell standardized off-the-shelf servers, Super Micro allows for extreme customization. This modular approach is why they were able to pivot to liquid-cooled racks faster than anyone else. For those using a Schwab Intelligent Portfolio or a Fidelity brokerage, it is important to understand that the self-investing crowd often misses the technical moat. It isn't just about sticking a GPU in a box, it's about the thermal management required to keep thousands of those GPUs from melting during a training run. As long as AI models keep getting larger, the physical reality of heat management favors the company with the most liquid-cooled experience. Looking at the institutional activity, we saw a notable update today as Impact Partnership Wealth LLC acquired over 17,000 shares. This might seem small for a multi-billion-dollar firm, but it's part of a broader trend of smart money nibbling at these levels while the online investing crowd remains paralyzed by the headlines from last year. The 52-week range of $25.71 to $66.44 shows just how much ground has been lost, but the current $30.06 price point is sitting right on a support level that is held through most of January. For those using Fidelity Investments or Fidelity ETFs to gain exposure to the sector, SMCI remains a high beta way to play the build-out of the digital world. The future outlook is a binary outcome. In one scenario, the DOJ investigation concludes with a manageable fine, and the reality of $36 billion in revenue forces a massive re-rating of the stock toward the average analyst target of $46. In the other scenario, the competition from Dell and HPE continues to compress margins below 9%, and the company becomes a low-margin hardware commodity player. However, the sheer size of the order book, specifically those $13 billion in Blackwell orders, suggests that the demand reality is currently far stronger than the market narrative of a struggling firm. When a company is securing $2 billion credit facilities to fund inventory, they aren't planning for a slowdown. In summary, Supermicro Computer at $30.06 is the definition of a high-risk, high-reward pivot point. The intraday movement is flat, but the underlying news cycle is moving at a breakneck pace. The expectation of a company drowned in accounting woes is being systematically dismantled by the reality of regained compliance, massive new credit lines, and a dominant position in the liquid cooling market. The gap between the fear of the past and the engineering of the future is where the opportunity lies. If you are using a Fidelity trading platform or a Robinhood app to manage your positions, the next few weeks, and specifically the Q2 fiscal 2026 delivery updates, will be the final word on whether this comeback is the real deal. The authority of their technical solutions is unquestioned. The only question remaining is the authority of their financial controls. Would you like me to analyze the specific competitive advantages of their liquid cooling patents compared to Dell, or perhaps look at the projected impact of Nvidia's next-gen chips on their 2027 revenue targets? Disclaimer: this content is for informational purposes. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. If you found this helpful, don't forget to like, comment, and share. Stay smart with your money.